Assalamualaikum everyone again. My name is Nadeem Mian. Thanks for joining us. So we're going to get started shortly, inshallah. I'm just seeing a few people just kind of logging in. Hope you're enjoying the fine weather in the GTA or wherever you are. Again, we'll get started shortly, inshallah. Right, 6:03. I'm just going to give it 2 more minutes and we'll get started shortly, inshallah. I guess what I'll do is while we kind of wait for people to join on, I was trying to get a poll on this, and I guess I had some technical issues. So just a show of hands, I wanted to know, how many people are bullish on the stock market for 2024, and we'll start with that, and then the next question is going to be how many people are bearish, and just if you can just maybe raise your hand if you think you're going to be bullish for the year. And I don't see many names out there. Okay. Got a few there. All right. All right. Okay, let's try bearish. How many people are bearish going in? Oh, we got more people that are bearish. Slightly more, I guess. And if you're, I guess the rest of everybody else is Switzerland on this one, I guess. All right. Again, just a couple more minutes and we'll get started. I will say that, we do have a Q&A box down below. I encourage everybody to, if you have questions, please put them in the Q&A. I will get to them towards the end of the presentation, and that's probably the most important part of our presentation is the interaction and the discussion. So you don't have to wait till the end of the presentation. You could just put your question in there. I'll probably get to it towards the end. And yeah, that's about it. So we're gonna get this party started shortly. And I'm gonna where is the all right, I'm just gonna share my screen here. All right, Bismillah ar-Rahman ar-Rahim. Assalamu alaikum, everyone. Thanks again for joining us this evening. My name is Nadeem Mian. I am the portfolio manager for Sharia Portfolio Canada, based out of the Oakville office. And so, tonight's webinar is, I would say, one of our most popular, if not the most popular webinar, which is basically a year in review and really kind of looking at the road ahead for 2024 and what I like to call our investment playbook. And so super excited. Hope you guys are as well. So we'll kind of, get the night started. I know some of you are regulars to our webinar. Great. Welcome back. I see a few names, new names. So, welcome. Hopefully, this session is going to be informative and, and you can take a lot from it. And, hopefully this is the start of something, bigger. So just a quick disclaimer. Of course, everything that's being presented today is for informational purposes only. Nothing should be construed as investment advice. We obviously encourage you to speak to your financial advisor for any investment advice or questions that you might have. So with that, just a brief background about myself, mostly for some of the newcomers. I've been kind of doing this for a long time. As you can see, the picture there is much younger, slimmer, and better looking. So I've been doing this for 25 years, alhamdulillah, primarily basically in the private wealth and investment management industry. Started off in New York, on Wall Street with a firm by the name of Oppenheimer. Spent about 4.5 years there, then kind of made my way back to Canada in '02. Had some roles with some of these Bay Street firms like HSBC Securities, Canaccord, Raymond James. And before I started with Sharia Portfolio in 2019, I was with RBC. Now with Sharia Portfolio, we've been, we got registered in January of 2020. So that's kind of, where my hands on the steering wheel went in terms of the firm. But with that, I think, with my experience, I've seen a lot, navigated through many crazy markets, bulls and bear cycles. And on my free time, sometimes I've done a little bit of writing as well. I contribute to the Islamic finance, finance news. And last but not least, originally I'm from Montreal. Go Habs, go! Graduate of Concordia University with a BCom, and I also am a CFA charter holder, which if you are not familiar with that, you can Google hardest exams in the world, and CFA's I think number 4 or something like that. Now, a little bit about the company. Basically, I'm not going to spend too much time on this, but we've been around since 2003. Alhamdulillah, the company's grown, as you can see through this timeline. In 2014, we were in 26 states, SEC registered. We started kicking the tires in 2019 or so, or 17 or whatever. And a lot of you also know us of our sister company, SP Funds, which now actually has 5 ETFs that trade on the New York Stock Exchange. That's our sister company. But specifically when it comes to Sharia Portfolio Canada, as I mentioned before, we got registered in January of 2020. And, we're registered in 4 provinces right now. And we also have clients, in globally as well. And this is just a follow up on that. So our main goal is obviously to offer professionally managed investment solutions to help Muslims reach their objectives, but make sure that it's being done in a Sharia compliant way and it doesn't compromise their values. We're financial advisors. We're discretionary portfolio management. We're a discretionary portfolio management firm. And as mentioned, we are registered in those 4 provinces: Ontario, Quebec, BC, and Alberta. And we also have clients globally. So, as mentioned, we are strictly dedicated to Sharia compliant investing. I think we're the only firm out there in Canada that can say that. And in terms of our offerings, we do have 2 offerings. One is an active service, which is more of a hands-on approach, as far as how we have an investment strategy with the goal of outperforming the market and some internal benchmarks. And that's going to basically be the focus of tonight, the active stuff. Some of you also might know us of our passive offering, which is basically an ETF based solution. I can definitely answer questions at the end of the night on that, but for the purpose of this presentation and tonight, we're going to be focused on the active, because that's where we're really kind of getting our handprints and on our portfolios and making hard decisions. We're partnered up with Fidelity Clearing Canada. That is our custodian bank and broker. Fidelity, if you don't know, is the parent company, is the 4th largest asset manager in the world. And with that partnership, all of our clients' accounts are insured by the CIPF, which is the Canadian Investment Protection Fund, guaranteeing up to $1 million of the market value per account. So if some of you were with us last year, what I did want to do was just kind of revisit, right? So basically January 5th, 2023, I did this webinar, and at that time kind of made some calls there. And so we're revisiting that, kind of a report card as far as what happened. And at that time, the argument really was being made that markets bottom before the data does. And at that time, one of the slides that I pointed out was the fact that the market had bottomed, and subsequently the Fed policy, the central bank policy, didn't change till months after. And I guess the point of all of this was that markets are always looking ahead and not focused on the current headlines. The second kind of piece of this chart also talked about just the annual returns. We understood that 2022 was a really tough year in the market. And the main question at that time was, 2022 was bad. Can 2023 be just as bad, if not worse? And again, I was making the argument at that time that we've seen this movie before, and at least kind of just using his history as reference, you could see that the market did bounce back the following year, right? The other slide I just wanted to kind of point out was this was actually the call that I made at that time. Was cautiously bullish. I probably should have taken out cautiously, but nonetheless, this was a time where I think the main question was, 2023 is going to be the year of the recession. I think that was the consensus at that time. If you were, reading the newspaper, or nobody reads the newspaper, but if you were just kind of, reading the headlines, that obviously didn't come to fruition, at least in 2023. But the argument that I was really making at that time was that inflation is falling faster than expectations. So that was, yes, that did happen. And the Fed at that time, I made the bet that they're going to halt their hawkishness in 2023, and we actually just saw that recently in their last meeting. The U.S. economy, I felt, was resilient enough, and that again was definitely the case because it did not hit a recession. Although in Canada and Europe, the economy has been a little bit more sluggish. So again, kind of got that right again. Again, the whole idea of recession and soft landing was there. Back-to-back negatives, that was kind of the main question that our clients and a lot of investors were asking. That did not happen. Clearly, this 2023 was a positive year for the markets. I'll dive into that later. And I guess the one area that I kind of got wrong was China reopening. I was a little bit bullish on that. I'm not going to be perfect. China was a little slow out of the gate, and 2023 was definitely a year where the overall Chinese market did underperform. And again, we're going to take a look at that. And as far as risks go, yes, the geopolitical, it's unfortunate. I know we're seeing what's going on, and a lot of what's going on is very near and dear to our heart. It is unfortunate that is still an issue. I will try to take off that, I guess you could say, my emotional lens and look at it from a market angle, and we're going to talk about that. But the Fed, and of course, the risk also was that the Fed continues its hawkish policy, which obviously didn't happen, right? So all in all, I guess the reason why I'm bringing this up is because it's good to kind of revisit, what the analysis or what the thought process was 12 months ago, and then kind of say, okay, where did we go right? Where did we go wrong? So alhamdulillah, we were right more than wrong, and that has kind of been reflected in our performance for 2023. So these were some of the headliners. I think that there's a lot of headlines, and geopolitical obviously is one of them, but I think these are the three main ones that I think are really what's kind of pulling the market and really were the catalysts. So number one, inflation drops like a rock. That, we saw that, and the next few slides are going to kind of maybe illustrate that a little bit better. Peak inflation, I think we hit the high point, I believe, in July of 2022. And then it subsequently for 2023, it was just pretty much just kind of a slide down. Commodities pulled back as well. Oil, you can see, is kind of not trading at its high. A lot of copper and some of these other metals are also not at their highs either. So that's kind of helped inflation. The Fed, the pivot, I think early on they were behind the curve. They've obviously, have paused any rate hikes in July. And, I think right now what the dot plot is showing is that, at least what the Fed members are saying is that they're looking at 3 rate cuts in 2024. And the last one is AI, basically artificial intelligence. And, I think, it was one of the most trending topics on Google Trends. If anybody ever looks at Google Trends, you could see that AI was always there, and it's not. Obviously, it's a very it's considered the most disruptive technology today. But at the same time, it's not just that. I mean, if you listen to conference calls of companies reporting, AI was was often referenced and mentioned in many conference calls, and so it was definitely something that I think impacted the market, and we saw that because the big tech and the Magnificent Seven, which is a term that I'll explain later, were the big beneficiaries of this, and it did really, I would say, help the market, but it really caught the headlines as well. Now, just a few points on inflation. As I mentioned, commodities did continue to drop. That was definitely the case. And it's more than just commodities. I mean, wages relative to output, was back to normal. And what that really means is that productivity kind of came back up. So the latest reading on the U.S. non-farm labor productive report in Q3 was that it increased to almost 111, and that's basically at an all-time high. So bottom line, I guess what you want to take from this, I know people here aren't economists, but what this is basically telling you is that the worker is very productive and very efficient, and the output that is putting out is translating into a higher number, right? Another one on inflation. Remember, we talked to when inflation was kind of hitting 9% and in that range. Supply chain was a big issue, right? We weren't getting cargo and all this other stuff, and ships were being docked and all that other stuff. So right now, if you take a look at the logistics manager index, it's at 50.6, and just to kind of give you an idea, the key thing is the lower the better. And this is basically at a level that it was pre-COVID. So meaning to say, what we're basically saying is that supply chains have become pretty much back to where they were before COVID. Now, during COVID, that number was extremely high because of all the cost and all the disruptions that were happening in that space. But as I mentioned, these are all kind of factors that helped inflation. And as I mentioned, it's not a 2024 story anymore. Now, the second thing was the Fed, right? Now, we talked about it being, behind the curve. So this here is just a chart from Bespoke Investment Group. And all the green line here is basically, what the US CPI was. And the blue line is the Federal Reserve and their interest rate hikes. And so you can see that, the idea, I mean, the goal really should be that there shouldn't be a huge diversion. And that's what I mean is that the Fed was behind because rates, the U.S. inflation rate really started to take off, and it was only months later that the Fed finally realized that this isn't a transitory thing and that we need to act. And finally, when they did it at a very alarming pace, a pace that has never been seen before, and that did create some disruptions. But ultimately, it finally caught up. And now, a lot of economists and a lot of market strategists might say that now they've overshot here and now they're overkilling this thing because, as you can see, CPI has started to come down. So and I think sometimes, I mean, I'm not a Fed expert. A lot's been written and said about what the Federal Reserve is doing and not doing, but clearly I think what they're trying to do is they're trying to basically build confidence, right? Because clearly they were wrong initially, and now they're trying to instill confidence that that they're not just gonna buckle and just start I guess shift policy that easy. So nonetheless, I think this is a situation where rates, the next path of rates are down, and that's what as I mentioned, some of the Fed members are saying, and even the market is actually anticipating more than 3 rate hikes, in 2024. The last thing I just wanted to mention was the big beneficiaries of AI. You can see here that basically, if you take a look here, this is essentially talking about names like Microsoft, Apple, NVIDIA, Amazon, Meta, Tesla, and Google. And ultimately, these guys, these names, these tech companies really, drove the S&P 500 and the return that we saw, in 2023. So it was a top-heavy market. At the end of the day, you could see that it contributed to basically about 50% of the returns. And if you take the top 25, that's about 80, close to 84. So AI and their valuations help lead tech the way. That was basically it. And 5 stocks, like I said, made up half the gains of the S&P 500. So kind of like the days when like Miami Heat, when they had those big 3 and just studs. Kind of that feeling here, right? It wasn't, even though some of the other, say, out of the 500 S&P stocks, even though some of the 495 other names might have had a positive year, they didn't exactly carry the team, right? Or they didn't carry the index. Now, this is an overall view of just different ETFs. So I used ETFs just to kind of give us a big picture as far as what did well, what didn't do well. So clearly NASDAQ, which is a tech heavy index, that led the way, up about 55%. Clearly, growth outpaced value. So that's the style. So growth stocks outperform value stocks in 2023. Healthcare and energy actually underperformed. Energy was the best performing sector in 2022. However, 2022. However, in 2023, they did underperform. And I guess, if you want, there's an ETF here, XLE, which is basically a basket of US energy stocks. And you can see that it was down for the year, right? And same thing with healthcare, which was only up about 2%. So in short, I mean, from a US standpoint, technology, it was pretty much, the one that was leading the way. Looking at other markets, China and emerging markets actually underperform. And as I mentioned before, I did get that call kind of wrong. However, I will say that, I think we're starting to see now signs of emerging markets starting to pick up. And I'll go through some of our picks, and actually I'll talk about that in a bit. But we are starting to see EM start to pick up, and I think that might have something to do with the fact that the US dollar is cooling. And bonds stabilize. So if anybody remembered this chart that I had last year, bond ETFs were down like double digits, something unseen. Now, we don't invest into bond ETFs, of course. We have a Sukuk ETF that we do buy for our clients, but it's important to at least keep an eye on the credit market and the bond market, just to get a big picture view as far as what's going on. So stability in the bond market actually does create stability in the equity markets. I guess that's what you want to take away from this. Now, as I mentioned, we're going to be talking about our active strategies. This is just the menu of portfolios that we have. We understand that every client is different. We have conservative clients all the way to aggressive and everything in between. And so again, for the purpose of this discussion, I just wanted to illustrate this, is that not every company that I mentioned or whatever is in every single portfolio. It's going to be different, right? Now, this is I guess 2023's performance. As you can see, I mean, alhamdulillah, I think we when I speak to clients and we recommend them a model, they always ask me. Excuse me, I'm just going to take this water here. They always ask us expected rate of return and all that other stuff. So I'm happy to say that we've actually beat our expected annual rate of return that we target. Now, aggressive, on a funny note, I mean, aggressive and growth are almost tied, which is kind of weird. So on a risk adjusted basis, I would say that the growth portfolio actually was pound for pound our best portfolio. The reason why aggressive started to pick up at the end is because we had a higher exposure into emerging markets. And as I mentioned, emerging markets was a little bit slow off the mat, but then really picked up in the last quarter or so. So what I wanted to do was just highlight a few of our top picks and performers, and a lot of this is maybe for some of those of you who are kicking the tires on us, just to kind of get an idea as far as who are these guys and what makes them different. And I didn't want to talk about the usual companies that we might have in our portfolio. Like it makes no, like, I can talk about Microsoft, but really, right? Let's try to maybe spice things up a little bit. So one name that I did want to bring up was Arista Networks, which is in our growth and our aggressive model. This is basically a leader in high performance switches and supplies hardware for main cloud titans such as Meta and Microsoft. So they are a supplier to those big magnificent fives. So I think this, although the big 7 or 5, those big tech companies get all the headlines, for us, I think the name of the game is now let's start looking at the other companies that are also going to kind of, benefit from the success of those big companies and are a little bit under the radar and better valued. So, this is a company that does have an AI play there. They do have products that target the AI sector. A couple of things that I like to look at as a portfolio manager when I'm picking stocks is, this is a company that's displayed what I call the triple play. In other words, it has a track record of beating the top, meaning the revenue, sales, and guides higher in terms of when they've been reporting. So this is a company that is definitely growing in terms of their revenue and their sales, and it's also outperforming whatever analysts have out there. And just a fun fact note: I know Nvidia, obviously, if even if you didn't own the stock, got a lot of the headlines. This stock is actually outperforming Nvidia over the last 6 months. So sometimes, it's good to put some of these numbers in perspective, I find. But yeah, this is definitely one of our winners in our portfolio. Another company, I just wanted to not make it all about tech. We have a med tech company in there, Transmedic. This is actually our top holding in our aggressive portfolio, as well as a top holding in our growth. And basically, this is a company that's revolutionizing organ transplant. And they have a patent technology. So a lot of the heart, liver, all those organs, that's what they're doing. So in other words, the old way of doing things was, if there was a donor, you'd put the heart in an ice, like literally an ice cooler, and you'd have to transport it to, a donor. So they have patented technology that actually, takes that archaic way of doing things and revolutionizes it. So this is definitely a small mid cap company. It's not a large cap. However, it's one of those stocks that did come on my radar because I just felt that they were doing something special, and they did get punished quite heavily, I should say, back in, I guess, call it the summer into November. And really what ended up happening was when expectations are high, and it's like that smart kid that got an A minus instead of an A, right? You start to question, okay, well, what's wrong with this kid? So that's really what happened in the summer when they announced their earnings. Everything was good, but it wasn't great enough, and ultimately the market sold off. They made an acquisition, and you know what? It just became a situation where the short interest was really high, and we were able to kind of double down on this stock, and it did bounce back in the following quarter, and alhamdulillah, it's worked out pretty well for us right now. International, I wanted to kind of give a different flavor. So one of our holdings also is PDD Holdings. This is basically an ADR. It's a Chinese company, trades in New York, and NASDAQ, I should say. Now, this is a top e-commerce player in China. In fact, the market cap is some of you might know of Alibaba. Well, PDD now is actually bigger than Alibaba in terms of market cap, and I'm really proud of this because as mentioned, and you saw on the ETF chart, China was actually negative for the year, and a lot of Chinese stocks, especially technology, were actually down for the year. If anybody pulled up a chart on Alibaba or JD, some of these other names, they weren't doing well. PDD is what I call, this is a stock picker stock where got the stock right, even though the sector was getting beaten up. And alhamdulillah, it actually worked out. It's been working out well for us. It's been a long-term hold for us. And this is also the company that is I found this out later, where they expanded internationally. The brand name is Temu. I actually found that brand name out for my daughter because I guess she bought a few things from that site. But yeah, it's a Chinese e-commerce company getting into global as well. This is a company that is basically growing their revenue and their EPS at 25% plus over the next few years. And you don't find too many companies out there like that. But again, I will preface by saying that we don't get married to stocks either. We definitely have a long-term view, but as the market changes, companies change, things change. We do have the ability to kind of reduce our position or even eliminate it. Right. The last one that I'll mention, also an international name, is Make My Trip. And this is actually, and this is also an ADR that trades on the Nasdaq, and it's an Indian company. So this is an Indian-based online travel service provider. I like to think of it as the Expedia or Priceline of India. And I guess, sometimes you take a look at companies from the bottom up. This is, I guess, more of a top down, meaning to say, India is definitely a country that is emerging in terms of its people and its economy. The demographics are very strong. The wealth effect, the wealth effects numbers are also coming out very strong. And so, what this really means is that we're taking a look at now consumer discretionary spending, right? That I think is one of the best ways to capitalize on a situation like this, where now you're having this wealth in India, and people are now starting to spend, right? And so India it's definitely an economy that's in a long secular trend. And Make My Trip is I think one of those companies that plays to that. And it's exclusively in India, so this is not a situation where they're going to get hit by another. It's not like Expedia or Priceline, where, for example, they might have great news in the US, but Europe is soft and Asia's a little bit of mismatch. So this, like I said, is a pure play on India, and it's in our aggressive model, and it's done well for us. Now I'm going to kind of start diving into, I guess, my market outlook for 2024. I've removed, I should have removed cautiously last year, but I'm going to remove it this year. So I am bullish. I think, although I will say that I think in the first half we could get consolidation, right? And consolidation is just another fancy word for maybe a pause or a correction. I'm not going to look at a crash. But yeah, I do think we can definitely get some, because we've had a strong November, December, and it's only natural that you get that. And I think there are some headwinds in the market, in the sense that the market's now looking at, okay, rate, when is the Fed going to cut rates? And there might be some questions on that. There could be some geopolitical issues. There could be many different headlines as well. There could be also issues on the labor market. Whatever they are, I think that the first half is going to be choppy, but I think in the second half of the year is where the market's going to make up most of its rally. So I am kind of targeting, the S&P at 5,200. I think we had a PM meeting last week, and I think this is the number that I threw out there. That is about a 14-15% increase from where we are right now. And I'm comfortable with that, because I think that if we'd had a double-digit return that like we did in 2023, it's not unnormal to see another double-digit return following that. In fact, it's rare. Well, I don't have the numbers to back it up, but I'll just leave it at that. And these are some of the reasons why, I guess, right? Inflation, as I said, is falling faster than expectations. So this definitely does give the Fed more leeway to ease the financial conditions. The Fed rate cut helps stock valuations. I think this is a big thing. And also, most importantly, it's bringing relief to credit markets. Now, I'll start with the valuation part first, right? Is that stock prices are all priced on a discount rate. That discount rate is an interest rate. And so this is really kind of a function of math, as the interest rate is the denominator in this case. So as you decrease the denominator, the price of the stock is only going to go higher. I've really kind of simplified finance 101, but this is there's a lot of empirical evidence that points to the fact that when when rates are low, the price of stocks does go higher. Brings relief to the credit markets. I think that's a big thing as well. I think earlier on in 2023, we saw there was issues behind some regional banks in the U.S. with Silicon Valley. Not to say that I think there's another tail risk out there, but with rates kind of coming down, it will bring some relief to the financial sectors, the banks. And I think that's just generally a good thing to have in the market, even though, again, we don't buy bank stocks. But overall, it does help. The recession, I think we had the same argument last year, where are we going to hit a recession or not? I think we can still avoid it. It looks like, right now the consensus is that we're not going to hit a recession, so that might actually bother me a little bit. But in general, I think we could still avoid a recession because overall, a lot of the economic indicators are positive. However, Europe and Canada, I'm still very cautious on those two, especially I know we're all Canadians here. And the reason is Canada is much more sensitive to interest rates than the US. And without diving too deep into it, I will kind of, give you, I guess, a major factor. And that is that in the US, when we're talking about interest rates, the first thing that should come to our mind is mortgage rates. And in the US, you can lock in your mortgage rate for 30 years. So in other words, if you bought a house and you locked in a mortgage rate at 30 years, it didn't matter what rates are doing, during that time. You're still locked into that rate, right? Whereas here in Canada and even Europe, there's a 5-year max basically. So if you bought a house, let's just say during the COVID time, and you lucky enough to lock it in for 5 years, guess what? In the next few years, a lot of Canadians are going to be coming up for renewal. And that's a little bit problematic because you probably locked it in at maybe 2% or something like that, whatever it was. And now you're waking up and you're figuring out that, wait a sec, it's no longer 2%, and now it's 6%. Now, I'm not an economist. I'm not a mortgage, broker or anything like that. But it is a little bit concerning. I guess that's what I'm trying to say is that, because of this little situation, I'm a little bit, cautious on Canada and even Europe because Europe also has that 5-year. I know the UK does, and I'm sure some of the other countries as well. Corporate capex starts to pick up. I think, the corporations over the last 2 years have not been spending. It's just been, with rates being where they are, corporations aren't really taking a whole lot of loans. That's hopefully going to come to an end, and we're going to start to see some positive, I guess, trends there. China reopening, I say take two because the last year I said this, and they were slow out of the gate. I think China finally, starts to get out of their post-COVID, I guess, post-COVID, what's the word I'm looking for? Depression, I guess. So definitely, I think China does start to emerge. Cooling of the US dollar, and that's going to help corporate earnings, and it's going to help EM. So markets have done fairly well considering the fact that the US dollar hasn't been that weak. But I think with US dollar kind of just cooling off a little bit, I think that's going to be pretty good for corporate earnings and emerging markets because it allows them to be more cost efficient. Or sorry, I should say when they repatriate their funds back to the US, they get more dollars from overseas. Finally, last but not least, I will have to mention a few things on risk. Of course, there's geopolitical risk. That's always something that we can't really call. Of course, the situation in the Middle East is what it is, unfortunately. The risk obviously is that if it does spread into the region, how does, from a market standpoint, not from a humanitarian standpoint, because that's a different topic, but from a market standpoint, how does that affect, the global economy, right? We're already starting to see a little bit of that with the whole Red Sea blockade, right? We're seeing ships kind of going now into the Horn of Africa, and that's creating a little bit of a cost situation there. But that's, for the time being, I think that's about it. U.S. elections, now, it's a risk because who really knows what happens, right, in November? But normally, I guess, as old as I am, I've seen a lot of U.S. elections, and they've been great events, believe it or not, for the market. But again, this year it's just one of those situations where you just hope things go smoothly, right? And of course, economic recession. I mean, the recession is still on the table. We're not totally out of the woods, because again, we're starting to see growth slowing, and now it's the question of, okay, is it just going to slow in soft land, or we're going to kind of tip over and go into recession? So these are just, I would say, three things that we probably need to keep an eye on. So now I'm just going to talk about the investment strategy and how we kind of manage money here. So we basically, first and foremost, out of all of this, I just want to kind of give you my thought process as far as a PM, how to what kind of what keeps me up at night, or what's my strategy. So I put this quote up where it's from Benjamin Graham. Right now, I manage the growth models, but Benjamin Graham is a value guy, but I think it just applies the same. So what it's really trying to say is that the essence of investment management is the management of risk, not the management of returns. Now, in football terms, which I like football, don't turn over the ball. That's all it means. So for me, when I'm looking at my portfolios, the models, I'm focused in on the ones that I'm getting wrong, not the ones that I'm getting right. Because the ones I'm getting right, I'm right on. You can only pat yourself on the back so much. But the ones that we're getting wrong are the ones that we need to focus in on. And I think if we can just manage those risks, then inshallah, we'll be able to enhance our return. So in terms of our strategy, though, specifically, yeah, we use a combination of ETFs and individual stocks to manage our active portfolios. The ETFs kind of give us that broad market exposure just to kind of keep us in line with the market. And the stock picking is where we're kind of making the alpha. We're managing risk, and we're also trying to put our investment thesis into the portfolios. Of course, we're Sharia compliant, and we think that Sharia compliant investing will continue to outperform. It has outperformed, the S&P 500, for example, versus the S&P Sharia 500. If anybody wants to do a Google search, you can do it yourself. You'll notice that over the past 10 years, the S&P 500 Sharia index has actually outperformed the S&P 500 by about 1.6% per annum for the last 10 years. So we think, obviously, with rates now no longer at zero, we think the pattern hopefully continues. And last but not least, right, and this is also very important, right? I so far I haven't really talked too much about technicals, but technical analysis is a big part of how I manage money. And it's, this is my quote actually: technicals must confirm the fundamentals. So in other words, what that means, if you're new to the technicals fundamentals game, is that fundamentals is the story, the quality story. What does this company do, the balance sheet and all that other stuff? Why? But technicals is the read on the market, the read on the stock. And that's what I'm trying to get to, is that the market is ultimately the voting machine. They're the ones that are going to tell you that you made the right call or the wrong call. So sometimes it's, I think it's very important that you get that confirmation. You make sure that the market is on the same side as you are. Because often what might happen is you might get the fundamentals right, but the technicals aren't working out. And then guess what? Eventually the market's going to prove you wrong. So again, there are different ways to slice a cat or whatever, skin a cat, I guess that's the expression. My view definitely is that you got to keep these two things in mind. The management of risk and the technicals must confirm the fundamentals. So now I'm going to dive into 2024. How are we positioning our portfolios? Now, as I mentioned, I manage the growth model. We do have a value model as well. My colleagues in the US, they're doing a webinar tomorrow. So if you'd like to kind of hear their thoughts, you can definitely, go to their website and log on to what they have to say. But for the purpose, again, for our discussion, as I said, I manage the growth models. Even though I like to think that I'm not totally a growth guy, I kind of go, anywhere the market tells me to go. But in general, we are definitely overweight technology, energy, emerging markets, and small caps. And as a general theme, we think that growth is going to outperform value, especially with the fact that rates are going down. And I'll just kind of cover, say a few words on these, on the sectors and why we're kind of bullish on them. When it comes to tech, we're still in a strong secular trend, especially with the AI tailwinds now. It's disruptive technology, and this is not going away, and it's only going to increase. Technology does a lot of good things, including, cut costs and help the tight labor markets that are out there. Again, I'm not going to go through every single bullet point, but definitely, weaker US dollar helps technology companies, because a lot of technology companies, derive their business from overseas. And if you're getting, more bang for your buck when you're bringing your money back, then that's going to do well for the stock. As I mentioned, we do expect some consolidation in the first half of this year. But the outperformance, and the last thing is, yeah, the outperformance. I think the market is going to be more broad-based in 2024, meaning the usual suspects, the Magnificent Seven. I'm not saying that they're not going to do well. I just think that the outperformance is going to come from beyond that, because a lot of these, large cap tech companies, I mean, they're trading at good valuations. You can make the argument that they can go higher, which they can, but I think the opportunity is definitely in, as I mentioned, those Aristas of the world, where they're under the radar, but they're profiting off of the big names, right? How we feel about energy. I know we were a bull on energy in 2022. We got that right. I think 2023, we got a little bit of a pause. Definitely. It wasn't something that added tremendously to our returns, but these companies are still paying dividends, so you're still getting paid to wait. Oil, although short term it has kind of dipped here a little bit, it still remains in a long-term uptrend despite this pullback that we've seen here. I think they all, obviously, with all that's been going on in the world, energy security is a big thing. And it's not just about oil, by the way. We're also looking at other renewables. For example, in our growth and our aggressive, we also have Cameco, which is the largest publicly traded uranium company. This is, again, a company that is in energy, but not that's the conventional energy that we think of. This is more renewable and kind of in that space. And so, yeah, I think there's still good valuation in that space. We still like it. We're high on emerging markets. I think the U.S. stock market has outperformed international markets by many years by a wide margin. I should have probably put up a chart here, but I didn't. But that has definitely been the story. But I think we're going to start to see some kind of narrowing of the gap. And 2024, there's a lot of exciting things going on in Latin America, which can do really well. India still looks very strong here, even from a technical standpoint as well, like when we're reading charts. China, I think I've mentioned China too many times on this call, but yeah, their reopening was definitely slow, but we're starting to see a comeback in them. And valuations are just they're attractive. Right now, like, I think Apple is still, despite it pulling back, I don't have the number, but I think Apple is still trading at around 29 times earnings. So, there are definitely companies in the emerging markets that are much cheaper than that. And, as I mentioned before, the weaker USD is definitely, a tailwind. And there's just some other stuff that is out there, for example, like the demographics and everything else, that we just feel that, the rest of the world is going to start to catch up to the US. And so we do want to have exposure, in those countries. And I'll just say one quick word about Sukuk, because it is a holding of ours. It's a fixed income holding. We think that, and it's an international fixed income. So let's keep that in mind. So it's in the same slide. Sukuk can benefit from rate, like any bond ETF, can benefit from rate cuts going down. But there's also possible for credit rating upgrade. In other words, some of the countries that are in Sukuk are emerging, are international, and so any possible upgrade is obviously can be positive, and so we are also bullish on Sukuk as well. Last but not least, we know we're big on small caps, and I guess I just pulled up a chart here that just talks about, relatively speaking, if you take a look at the S&P 500 large cap and where its valuation is right now, it's trading basically close to 20 times forward earnings. Whereas if you take a look at small and mid cap, you're looking at around 15 times earnings. So there is this gap here that talks, and PE is just a way of creating some type of a valuation. It's not the only thing that we look at, but it helps to figure out where a sector or a stock is relative to other, when you're comparing it to other things, right? So definitely it's wide. Historically, it's wide. You can see that. So we do think that there will be a reversion to the mean on this one. And all valuations have actually picked up, especially large cap. But I think that's where we feel that the opportunities might happen. And rates coming down, small caps can actually benefit more so than large caps when it comes to rates coming down. So that's definitely, a sector that we're looking at. In fact, like I mentioned, Transmedic, which is a small mid cap company, that's in this space, right? And with that, I'm just going to stop there. And I'll start to kind of answer questions. And again, thank you for listening. Hopefully, you found this informative and enjoyable. So we'll kind of get to the questions right now. Okay, okay, well, the first question is, can we review the session later if it's recorded? Yes, so we will be uploading this to our YouTube channel. If you registered for it, I think we will be probably sending up sending a follow-up email, to watch the replay. That same brother asked, please explain terminology and acronyms while presenting for laymen. Okay, well, I apologize for that, brother. Hopefully I wasn't going too fast. And sometimes maybe I get a little too excited. And so that's what tends to maybe happen. Right here. Many ways to skin a potato better. Okay, fine. We'll just leave that out there. Okay, thanks. So I guess one brother's asking or sister's asking, thanks for a great presentation. Will you be sharing this deck with the attendees? Well, I mean, if you definitely do reach out to me, I can definitely send you the deck. So just email me. My email's over here. Just jot it down and just send me a quick email, and then I'll be happy to share the slide deck with you. Right? Okay. So what's the difference in the performance between passive and active? Okay. So we have passive models, and in the same kind of spectrum that you saw earlier, where we're looking at conservative, income, moderate, aggressive, growth, and aggressive, but just using ETFs. I you know I don't have the exact numbers on me, right? However, what I can say is, I know our aggressive and our growth models did outperform our passive, and even possibly the moderate as well. If you want, if you can just email me, because again, for the purpose of the discussion, I wasn't going to bring up the ETF models, but I'll tell you what, if you just message me, I can definitely kind of give you some better numbers. But our passive models did well as well. Like they out, like in a lot of cases, the S&P was up 24%. And if I recall, I believe the aggressive ETF model was also was actually slightly better than 24%. So I know I didn't fully answer your question, but again, if you just send me an email, I'll follow up with that. All right. How do you view semiconductors for 2024? Yeah, I think semiconductors are now what I would say one of the strongest sectors to look at when it comes to what's happening in the world in terms of the economy. Right? These are chips, these are building blocks for basically technology. So as semiconductors go, so goes the global economy, right? Or vice versa. So yeah, I'm definitely bullish on semiconductors. I mean, we own AMD. It's been a long-term hold in our portfolios. I know we don't own NVIDIA. In hindsight, maybe I wish I did. But yeah, definitely we're bullish on semiconductors. I know there are obviously some risks out there in terms of some of the government regulations and but what's been going on with China and the US. However, semiconductors have definitely become hot commodities and prized possessions. And this is definitely a sector that we're bullish on, especially with the emergence of AI. Okay, is the Sharia compliant S&P fund? Is the Sharia compliant S&P fund RSP eligible fund? Yes, it is. So all of our funds are RSP eligible. All of them are listed on the New York Stock Exchange, so that by default, I think that should be eligible for RSP. I think there are some investments that not Sharia portfolio stuff, but Most things are RSP eligible, especially our funds. Okay. Oops, sorry. Okay. Oh wow. So do you know how many rate priced in the markets Ash Lakhani? Oh, nice to hear from you, brother Ash. Okay, I hope it's the same one. So to answer that question, I'm so happy to see your name up here. So as far as rate hikes, right now the Fed futures is pricing in about six rate is the last time I checked, it was about basically six rate cuts in 2024. Now, for what it's worth, the Fed members, the Fed dot plots, which is kind of what the Federal Reserve puts out, they've said three. So clearly, the market is anticipating, much more than three. So and so that's kind of the game that we play now, right? Is that the bar becomes six now instead of three, in my opinion. So, I know when we talked about risk, I didn't mention interest rate risk, but I think that could be a risk to the market in the sense that, the market is expecting six, but what if they only get five, right? Does that create the market pulling back because the expectation is six, right? That's always going to be a situation. So, but to answer your question, um, it's six right now. And hopefully, Ash, you're not done asking questions because you have the best questions. All right, I got another one here. How can you help to moving any accounts from other financial institutions of Canada, like MD Management or Scotiabank for RSP TF? Okay, this is a great question from Brother Muhammad Arham. Okay, so what basically it's an easy process, right? For you to, if you wanted to move your account over from MD or any other firm over to us, first and foremost, definitely reach out to me. You have my information there. Send me an email or call me or text me, whatever. The first thing is, what would I like to do is just have a quick initial chat, find out exactly what accounts you have, preferably maybe even just get a couple of statements so that we can have in front of us. And then subsequently, what we do is we would open up those same accounts that you have, and then we have a transfer form. We submit the transfer form, and everything comes over as is. That's how we typically 90% of the time we do it. As is simply means that whatever you have at that firm just comes over to us. So there's no withdrawal or anything like that. It goes from RSP to RSP. MD Management or most financial institutions will probably charge you a fee like 120, 100 or 150 bucks. But it's very seamless, and it can take maybe about anywhere. I've seen transfers happen in as little as 3 business days or 4 business days, or maybe 2 weeks, right? Depending on the institution that we're working with. So it's very easy. And what I can do is I can definitely send you a link to kind of get the process started. It's an onboarding link. We'll just gather your basic information down, fill it out, send me an email, and then myself and my onboarding team can definitely help you, inshallah. Um, all right. Thanks for answering earlier. I'll reach out accordingly. But just to clarify, I'm trying to make a decision if I should proceed with passive investing or switch to active, particularly that I'm at an entry point for active. Thanks. Okay. So, of course, I'm an active guy. I actually did another webinar on active versus passive investing. If you go onto our website, you can definitely, I think we have the replay there, so you can definitely look at it. My viewpoint is this, and I'll just summarize it because there's slides in there that show this. Passive investing outperformed active from basically 2010 to call it COVID, right? Passive investing consistently outperformed. Maybe there's 1 year that active did better. Now, if you dive a little bit deeper, and maybe if you take a look at my opinion, is that was an era where you had zero interest rates and the market was trending higher, just in an upside. So the name of the game was cheap money, get me access to the market at the lowest cost, and everyone's gonna make money. And that's what basically happened. Now, if you take a look at the decade before 2010, from 2000 to 2010, that was a decade where there was interest rates weren't at zero. There were actually real interest rates, and active actually outperformed passive. And again, I gave a webinar on this, and I had some Morningstar charts that kind of pointed this out. But that was the case, and so I think what ends up, and that decade was not just a simple uptrending market. It was a market that had its peaks and valleys, and I think that sometimes in those markets, you're going to get active. So I think right now, my viewpoint is that, yeah, I think you should go for active, because we're not going to be in a zero interest rate environment, number one. Number two, although I'm bullish, right, I think outperformance is going to come from different areas of the market. I mean, there's deglobalization going on, and I haven't talked about that in this webinar, but deglobalization is a real thing, where when for the most part of my 25 years of the business, everything was interlinked so nicely, in the sense that you wake up in the morning, you see the Asian markets are up, and then the U.S. market would also be up, and vice versa, right? U.S. market closes strong, next morning Asia's up. There's now a disconnect. There's disconnect going on in different markets, and when you're seeing that, that's when I think active investing actually can make a difference, because it's not just let's everybody just ride with the tide, right? So that's my answer, is that I definitely think that active is going to be the way to go for the next few years. What are your thoughts on the Magnificent Seven? Are you bullish or bearish going into 2024? So, I think they're great companies, first and foremost, right? But great companies doesn't mean that, they're going to be great investments either, right? Because we're talking about price. I still think they'll do well. I just think that the outperformance is going to come from other areas. The Magnificent Seven was up, what was the average? And I had the slide here, but it was something ridiculous. Of course, it was like 50% or so, right? Plus, you can't expect another 50% from these trillion-dollar companies. That's just a little bit unheard of. So I think my view is I'm not necessarily bearish on them. I'm still bullish on them, but I expect them to consolidate in the first half. We've already seen Apple, for example, like get hit really hard. Just this past, just this past couple of months, it's actually taken a big of a hit. So I'm not exactly bearish on them, but I'm not exactly crazy bullish. But over the long run, yeah, they're good companies. I just think that there are better opportunities in other names. How do we port RSPs over process? Okay, so I think I answered this question as well. What I'm going to do is, I wish I would have had one of my colleagues on the call. I'm going to put up a link in the chat where it's an onboarding link, or maybe I'm not going to be able to do this, but I'll tell you what. If you go onto our website, right, there's going to be a link that says Get Started. And if you go there, there'll be it'll lead you to a link that says Open an Account. Fill out that information, and you can definitely, get the process started. Of course, the other way is just send me an email, right? And I'll walk you through everything. But it's an easy process. It's just a matter of getting your statement, filling out your information with us, and the transfer is just, it takes like I said, anywhere from 5 to 2 weeks. 5 days to 2 weeks. How frequently are your funds updated in the passive portfolio? Do you sell them in expectation of a downturn and rebuy at a lower, or is it constant investment over time? So, I mean, when it comes to the passive, it's more kind of based on just the target asset allocation. So, in other words, it's not necessarily a call on the market. It's more, for example, if in our moderate portfolio, we have, say, a 60% weighting in equity, and let's just say the target, let's just say the portfolio is now tilting at, say, 65 plus. In that case, what we're simply going to do is we'll probably rebalance the portfolio and bring it back down to 60, right? Just because it's exceeded the target. So we're not necessarily, I would say, making those active calls. From time to time, I would say, maybe, at the start of the year, for example, if we're bullish or bearish, say, going in, we might make a decision there. but I would say that that would be the strategy pretty much, at least for the year. We're not going to be flipping strategies quarter for quarter or anything like that. Okay. Even the current share also TF. I'm not understanding this question. Even the current share also T/F2. Okay. Maybe brother Muhammad Arham, if you can just kind of repost that question. I don't quite get that question. All right, so we have another one here. What is the potential impact of a wider Middle East conflict on the markets? Yeah, well, again, there's obviously tough images to watch. And that is a risk. I think if if this conflict does escalate and it starts to draw other parties in, then yeah, I think you can definitely get some headwinds in the market. I mean, anytime risk enters into the market, it's going to make investors gravitate towards safer securities. That's just kind of a general opinion or theme that does happen. Um, you might see areas such as oil, spike, because now we've gone from a small pocket to basically a wider region, right? Unfortunately, again, we don't invest in this sector, but yeah, we've already started to see signs of this conflict, hit certain sectors such as the weapon makers. Like, again, we don't invest in weapon makers, but definitely the weapon stocks have done well. Even on a lesser note, we're even starting to see like some of the shipping companies, they've done really well, in this conflict, believe it or not, because they've increased shipping rates. So it's going to be quite interesting, but it's something that we would definitely keep an eye on, and we would navigate as the situation kind of progresses. Do you recommend that we invest primarily outside of Canada? Okay, well, yeah, I can definitely answer that question. Uh, Two things here. Number one, we're obviously Sharia compliant. And number two, we're trying to build diversified portfolios. So when you take those two things into consideration, what ends up happening is you almost have to be mostly outside of Canada. The Canadian market, the Canadian stock market really is built up of financials, the banks, insurance companies, energy, materials, meaning mining companies, and maybe just a handful of other names out there, right? I mean, you might have Shopify and a few other names like Magna, but it's not a very deep market, right? And of course, when you're adding Sharia compliance onto it, you already eliminating the financials, and you're already eliminating a lot of companies that are highly leveraged and don't meet the debt ratio. So for that reason, yes, we do go outside of Canada. Although I will say that in some of our, portfolios, like our weighting in Canada is about in the low teens, right? So we do have a few names there. And the other thing that I'll mention about Canada is, like I said, I was cautious on Canada, and I still am. The Canadian companies that we do own in our portfolio, like 95% of the business is not even in Canada. So, for example, we own CNQ, which is Canadian Natural Resources. It's a company that's in the oil and gas business, right? They're an explorer. They're an E&P company. They don't. I don't know how much oil they sell to Canadians, but it's not a whole lot. Everything is pretty much going to the U.S. and it's price performance, its company's performance is going to be dictated on the global price of oil, not necessarily what's going on in Canada. Likewise, for example, we have Shopify in some of our models, and Shopify, again, I think 95% of the business is not even in Canada; it's outside of Canada. So that's our Canadian strategy, at least right now. Now, of course, if things change in Canada, we feel that we need to kind of we're getting bullshit. We'll try to find a Sharia compliant way to do it, but for now, that's kind of our position. Okay. For people fresh to trading, what services does Sharia portfolio have to offer professional guidance? Well, we're financial advisors. We're like a lot of this, what I'm doing right now is teaching. In fact, a lot of my webinars are teaching people about investing. And so that's one thing. And I think, and I'm still a student of the game. I still learn every day. The market teaches me something every day. So alhamdulillah, I'm learning as well. But yeah, I've learned a lot because I've been doing this for so long. But in terms of guidance, I think, sometimes it's just experience, right? Once you're kind of in it, you experience can kind of be a guidance. And I think for us, especially for new investors, we tell them is that, listen, don't let your first experience be your last experience, right? Too many times I've come across brothers and sisters who are new to the investing game, and they're just listening to a neighbor or friend or something like that, and they got themselves involved into something and it blew up, and now they're like, oh, you know what, I put a little bit of here and look what happened, right? And that kind of is become that's it, right? So I try to say, look, build it, like build a core and go from there, right? So I think in terms of professional guidance, we're advisors. We're not here to sell you a product. We're here to kind of service you and answer questions, and that's what we do. So I think that alone, that experience will definitely help. Uh, I got another one here. Sullivan, can we invest in USD rather than Canadian dollar? Well, good news. Most of what we do is actually in the USD. As I mentioned before, our portfolios are predominantly not in Canada, or even some of the Canadian stocks that we own, right, which is about 15% or so. So most of our portfolios are based, companies and investments that are priced in US dollars or trade in the US stock exchange. So typically what we do is, yeah, you can use your Canadian dollars to buy these US stocks, but the most cost efficient way and the better way to do it, in my opinion, is we convert the funds to US and then we subsequently, do the investing there. As a client in Canada, you can definitely see your value consolidated back to Canadian dollars. But yeah, for sure, what we're doing is we're investing in the US basically. Right. Okay. Can we TNF stocks, trade stocks? I'm thinking. Can we trade stocks, share Tesla, Meta, Neo already purchased an RSP or TFSA account if I move to share portfolio? Okay. So basically, I mean, some of these names we might have in our portfolio. We are discretionary portfolio managers, meaning we're actively managing your money, and we're buying the stocks for you basically, right? If in your portfolio you have a holding that you feel that, look, you know what, you manage my money but keep this share as is, sure, we can do that on a one-off, maybe a two-off, right? But that's not what our service is designed for. Like we explain you the strategy, we explain you our portfolios and everything, but ultimately, you do give us the steering wheel and we do drive the car, right? And if at times you feel that, look, you know what, maybe if we can just do this or that, we can customize it and we can definitely hold these. So all our portfolios obviously hold stocks and ETFs. And if there's a stock in your account or portfolio that you feel that you want to keep it, we can definitely customize it. Okay. Does share your portfolio accounts support wire transfers out money to other countries like Dubai, USA, for investment purposes? Support wire transfers out to other. Yeah, well, I mean, we have international clients. So international clients, like, if they when they send us money, we send them money. We do wire transfers on a regular basis. That's nothing new for us. So if you are not living in Canada and you're somewhere else, like in the Gulf or whatever, and you want us to wire you money or vice versa, we can definitely do that. US, for the most part, I mean, for the record, like our Canadian office, we don't deal with US clients. Our US office does. We're not. It's funny this way that we can have clients almost all over the world, but we can't have them in the US because of security laws. But if you, for example, have an RSP and you move to the US, we can definitely help you with that. So yeah, I mean, again, but yeah, we can transfer money both into the US and around the world. Second here. Okay, so we're going to take a step back here. Can you explain ETF in more details? So ETF is called an exchange traded fund. So I don't know, maybe you might be familiar with mutual funds or not, but an exchange traded fund is basically a fund that has another basket or pool of stocks or other investments. It could be sukuk, it could be stocks, it could be whatever, right? But it's a fund that has another, I guess, basket of companies or investments. And typically what ETFs do is they're passively managed, most of them are. They're linked to an index and they'll try to track that index. So again, we obviously use the Sharia compliant indexes. So there are Sharia compliant indexes out there. The fund is simply designed to track that index. It's not going to make an active call like I've been doing all night. It's not going to say, oh, we like Tesla, we don't like Tesla, and we're going to add it or not add it. No, it's not going to do that. What it's going to do instead is if the index has Tesla, it's going to own Tesla and it's going to own the exact percentage that the index owns. That's what a passively managed ETF does. That tracks an index. So it's a good way of owning a basket of securities, basically. And they're listed on the exchanges. They're not purchased through like mutual funds. How are my taxes affected when buying U.S. stocks? Will my returns be sheltered under TFSA, or will I be paying tax in the States? Okay, so that's a good question here. Although I am not a tax advisor, I'm just going to kind of give you some high level kind of tax 101 investment knowledge. Will my returns be sheltered under tax, or will I be paying tax in the U.S. states? Okay, so I'm assuming you're Canadian, right? And you own U.S., for example, investments. So one thing I'll just say is that if it's an RSP account, the IRS in the US recognizes the RSP. So there's no problem there in the sense that any money that you make off of US stocks in your RSP account are not going to be subject to any special taxes by the US. That's number one. Number two, capital gains, same thing. Whether you made a capital gain on a US stock or a Canadian stock, they typically get treated the same. Now, the only US tax issue that you do have to worry about is, yes, in the tax-free savings account, if a US fund or company or stock pays a dividend, then in the TFSA and the RESP account, actually, the IRS will take 15% as a withholding tax, okay, because the IRS doesn't recognize the TFSA or the RESP, okay? So it's only the income, it's not the capital gain. So that's the other thing you want to keep in mind is that if you make a capital gain, meaning you bought this stock at 20 and you sold it at 25, that's a $5 gain. That's tax-free. However, if you bought a stock at 20 and the stock paid you a $5 dividend, then guess what? The IRS is going to take 15% of that $5. Okay, so that's going to happen in a TFSA account. So the only thing is that, yeah, you're going to have to worry about that. But outside of that 15%, there's not, I think it's 15%. Could be 20, but I'm pretty sure it's 15. So outside of that withholding tax, you're not subject to any other, Canadian or US taxes. Is there a minimum amount to avail your advising services? So, I mean, for the active portfolios, that's the one that I'm probably most focused in on. The minimum amount is 100,000. We do have the passive offering as well, and we can definitely even start at that level. For the passive, it's only $1,000 to start. So you can, I mean, that's really kind of, there for the general public, for new investors, young investors, anybody to kind of look to get started. 1,000 would kind of be the minimum for that. And so with that, I think we're going to call it the night. Well, yeah, thank you again. Maybe I'll take one last question because this is an important one. What is the fee you charge for active investing? Because I know people are going to want to know that. So the fee is tiered based, meaning to say it depends on how much you have with us. So as I said, the minimum is 100,000 and the fee starts at 1.5%. And then it's tiered pricing. So, I think the next break point is 500,000. The fee drops down from 1.5 to 1.2. I think at 750, it's at 1. And then at $1 million plus, I think it's at 0.75. So, don't quote me exactly on this, but basically it starts at 1.5% at 100,000. And then depending on how much you have, the fee can go down to as little as 0.75. Okay. So again, Jazakallah khair, everyone, for attending. I think most of you hung on, which is great. And I really enjoyed this, and hopefully I look forward to hearing from some of you brothers and sisters, from after this, inshallah. All right, Jazakallah khair. Thank you again. Assalamu alaikum.